Europe is in decline, Europe is in crisis, Europe is falling behind the United States and China. You've heard those sentences 1,000 times, whether it be on the news or on YouTube. Some argue that Europe is losing its economic significance. A comparison of GDP per capita with the US, showing a widening gap since 1995, appears to support this view. Yet, common reasons cited for this trend, such as an aging population, the lack of major tech companies, and the stereotype of less industrious Europeans, are largely debunked myths. Indeed, the success of several European nations in advancing economically suggests there's more to the story. So, what truly lies behind Europe's economic challenges? And might Europe be on the verge of overcoming these issues? To unravel these queries, it's crucial to trace back to the origins of the current situation. In the 1990s, Europe was heralded as a burgeoning economic powerhouse, with predictions of an imminent economic showdown with the United States. The foundation for this discussion is often a chart of gross domestic product, GDP, which quantifies economic output. Although Europe's GDP has seen consistent growth over the years, other nations have accelerated at a faster pace, leading to Europe's relative economic decline and a decreased share in global GDP. Yet, relying solely on GDP as an indicator doesn't provide the complete picture. GDP calculates the total income generated within an economy, which can be broken down into the workforce size, the hours worked, and the overall productivity of the labor force. By dissecting the data, we can grasp why the EU's GDP has traditionally been lower than that of the United States. The key factor is that European workers typically work 15 to 25% fewer hours than their American counterparts, resulting in lower output. This insight also sheds light on why the US has experienced faster growth over the past century. With a population boost from immigration and higher birth rates, the US had more workers to fuel its economic expansion. However, Europe has made up for this with its high productivity levels. In fact, since 1995, if Europeans worked as many hours as Americans, several Western and Northern European countries would have boasted per capita GDPs surpassing that of the US. This choice to work fewer hours is a conscious one by Europeans and their governments, which allows for better quality of life at the expense of GDP. While hours worked and numbers of workers explained most of Europe's relatively smaller GDP compared to the United States. Up until the 1990s, it's not what has both economists and politicians most worried. Instead, their concern is on Europe's lost productivity edge on the United States. One of Europe's most prominent economists is Maria João Rodrigues, a foreign minister for Portugal and MEP. For the past 25 years, she's worked on European competitiveness. She actually wrote the EU's first strategy to deal with its greatest economic challenge. Back in the 1990s, as the EU started to notice some of the changes in the global economy, Europe was faced with two potential paths. We could either go to reducing wages or to go another way, which would be to invest in creativity, innovation and education to improve competitiveness. That transformation and understanding was driven by one thing. It was fundamentally the digital revolution. In anticipation for this trend position, the EU set out the Lisbon Strategy in 2000. It aims to transform Europe into a knowledge economy. It aims to raise government spending to 3% of GDP, invest massively in digital infrastructure, and train a highly skilled workforce. The success of the countries that fully adopted it pointed to being the right strategy. But this strategy and its successor program, Europe 2020, failed to be implemented by several European countries. At the start of the launch, the strategy already had a proper lack of financial means. It actually failed the capacity to implement. A lot of Europe's economic trouble can be explained by its incomplete transition to a knowledge-based economy since 1995. In fact, according to a study, the US's impressive increases in productivity between 1995 and 2005 can largely be explained by the development of intellectual property. In other words, the knowledge economy. The thing is, Europe started in a relatively bad position to adapt to this transition. There are four main reasons. The first is simply that Europe was late to the digital transition, which started in Silicon Valley in California. This meant that the US simply had a head start connecting schools and could then build on that to innovate more, with many business leaders already being digital natives in the 1990s. The second reason that affected Europe's transition was the nature of its labor markets. Both high youth unemployments over the past 2 decades and the older population means that new ideas took longer to spread to Europe and its companies than it did in the United States. This was compounded by the fact that Europe has less economic competition compared to the United States. As a result of economic fragmentation, this additional competition in the United States means that American firms are generally better managed than the European counterparts. As a result of survival of the fittest dynamics, these are forced to deploy new technologies better and faster than European firms, leading to more efficient use of resources and a higher productivity. This was further worsened by the continued fragmentation of the European market, particularly for services. In Europe, cross-border trade in services is about half the level of European trading goods, as a result of both cross-border regulation and language barriers. This offers a competitive advantage to the homogeneous US, which could quickly build tech champions at home that would then dominate the globe. This fragmentation and diminished competition means that European companies are much smaller than their American counterparts. Small European companies account for 60% of total employment, compared to 20% in the United States. These smaller firms often struggle with productivity and are less likely to invest in new technologies, such as digitalization. Additionally, a significant factor affecting the last decade has been the fallout from both the 2008 financial crisis and the 2015 euro crisis. It was during this time that Europe began to significantly fall behind, as governments cut funding for research and development and education and reduced overall investment in a rush to implement austerity measures. This led to a decline in technological innovation and created an unfavorable environment for investment in European companies. In fact, it took over 10 years for investment levels in Europe to bounce back to what they were before the financial crisis. The lack of investment in new and emerging sectors meant that Europe continued to rely on older economic sectors, which offered limited opportunities for groundbreaking change or growth. So to summarize, Europe is a continent with a fragmented economy and an aging workforce that lagged behind on digitalization and innovation. Due to austerity for the past 2 decades, it's actually possible to distinguish between 4 different categories of countries in Europe, looking into the labor productivity and productivity growth over the past 20 years. There are countries that are doing well with Denmark, Sweden, Switzerland and Ireland, which are close to being on par with the United States. When it comes to productivity growth, then there is a low productivity growth category, made up solely of Greece, which saw productivity collapse after a decade of intense austerity. Most of Europe over the past decades has belonged to the stagnating high productivity and low productivity growth category. This includes countries like France, Spain or Italy, but also countries which at first sight are performing well, like the Netherlands or Finland, and to a lesser extent Germany. Then there are the countries with low productivity and high growth like Poland or the Czech Republic, and other post-communist countries that have been catching up economically with the rest of Europe since they joined the European Union. So now we know why Europe underperformed. This underperformance affected Europe much more broadly than we could have thought. So where does that leave Europe, and can it catch up with the United States? While most European countries fall under high productivity, low growth, dividing Europe geographically makes more sense. If we're to look at the future of Europe, and these lines correspond roughly to Northern, Southern, and Central and Eastern Europe. Let's start by examining the regions facing the most significant obstacles. Southern Europe was relatively in step with Northern Europe until 2008. However, the financial crisis widened the gap between EU member states, largely due to challenging demographics, including some of the lowest birth rates in Europe, a young workforce moving abroad, and significant losses due to the crisis. Countries like Italy and Greece in particular find themselves in a tough position to boost investment and enhance productivity for the future. Then there's Eastern Europe, which began with lower productivity levels, but has experienced remarkable productivity growth over the last 2 decades as it caught up with the rest of Europe. Unlike Southern Europe, Eastern European countries do not face the same debt issues, positioning them differently in the economic landscape of the EU. Terrible demographics, mostly due to immigration to Western and Northern Europe, will put constraints on their prospects in the coming decades. Then there is Northern Europe, which adopted relatively well to the knowledge-based economy and experienced little austerity during the financial crisis. They were able to keep investing in education, tech, and digitalization. These countries were also able to compensate somewhat for their bad demographics, thanks to immigration from the rest of Europe, but also other parts of the world. Due to steady growth in the 2000s and 2010s, they have only limited debt, so they can invest more into the future as a result. They're relatively well positioned. The last category is made up solely of France. They fit somewhere in between the poor performance of Southern Europe and the relatively good performance of northern European countries. France has far healthier demographics than the average European country owing to a higher birth rate. But their debt being much higher than Northern Europe means they have limited room for investment. To correct course in the future, as you've noticed, there's one European country that I have not mentioned, and that is the United Kingdom. Despite having a solid tech industry, the UK has had little productivity growth and little investment over the past 3 decades. In fact, as a result of Brexit, some have put the country in the Southern Europe category economically speaking. So while Europe is down, there's actually some encouraging developments. During COVID, Europe learned from its mistakes and didn't go for austerity once again. Instead of opting to invest billions into its economy for Southern Europe, the coveted recovery package, Next Generation EU, is actually a Lisbon strategy package in disguise. But this time with the budget that could put them on track to catch up with Northern Europe. The pandemic provided shock therapy levels of digitalization to the lives of many Europeans. Even in tech, there is some good news for Europe. With the continent's startup ecosystem maturing along with funding opportunities for European companies, potentially opening the door to new economic sectors and revive productivity growth. Yet despite reasons for cautious optimism on the financing front, Europe faces several big challenges. It will face difficulty keeping its aging population skills up to level. Increased welfare and pension spending for an aging population will stretch already thinned-out government budgets, particularly in Southern Europe, where high levels of debt make it harder to invest. Its tamed version of capitalism, as opposed to the cutthroat capitalism in the US, leads to less well-managed and thus less profitable and productive firms than in the United States. More important still, the tendency to open the subsidy tab every time it feels it's falling behind means it isn't pushing for the structural reforms to its market or business culture. That may guarantee its success in the future.